been a tumultuous week on the global markets. Chinese markets closed down completely twice, and Asian and European markets fell. But why should we care? Phil Scott is director at SI Capital Stockbrokers in Godalming and can fill us in. Hi, Phil.
Hi, Danny. Good morning to you.
Morning to you. Right, help us out here, because I'm not sure most of us understand this.
Well,
what's been happening?
Okay, well, China, the second largest economy in the world, is bound to be having an impact on financial markets at its most basic. The US, of course, being the biggest economy. What we've seen here, and we saw the same at the end of August last year, is that the Chinese are desperately trying to keep their growth rate going, hopefully at about 7% a year. And to do this, they're having to use all forms of tax cuts, interest rate cuts, and the one that you've just mentioned is a currency devaluation, which will effectively make their exports more competitive. This is all in the spirit of trying to drive that growth, as I say. The problem with the currency devaluation is that it makes the world economy more challenged. Let's just keep it simple, because people that export to China, such as Europe and the Americans, they're a buyer of our goods as well. All of a sudden, our goods look more expensive to the Chinese. So currency devaluations have, ripple effects all over the globe in terms of growth rates. So that is effectively what everybody's getting jittery about. And of course, we have to put this in the context, Danny, of a US economy and a UK economy, actually, which is doing all right and requiring probably an interest rate rise. Well, the Americans have already raised their interest rate at Christmas time, but we could be looking at further interest rate rises from the Americans and from the Bank of England, of course. So interest rate rises when China's doing what it's doing. This is all quite dangerous stuff, and markets are wobbling. That's it in a nutshell.
Thank you very much indeed. Let's unpick some of that a little bit, because actually I think most people you might talk to in the street here would say, well, it doesn't feel like we're having a really good time, so actually putting interest rates up would be difficult for us.
Yeah, I mean, I think we have become accustomed to low interest rates. The UK base rate's been at 0.5 of 1%, I think, for 5 or 6 years. We've all been used to that, and it's actually been quite handy to an extent, because if it's meant we've had a little bit more money to spend each month in the shops as opposed to having to pay it on the mortgage, well, that's been good. The other problem with it, of course, though, is that a lot of people have increased their debt levels whilst interest rates have been so low. And the Bank of England, of course, is very aware of this and is trying to manage what they call asset bubbles. And, of course, we all know that the property market has been a very strong asset class for years, really. And, of course, getting on the property ladder, as we well know, is incredibly difficult, perhaps to a new buyer. And this is all largely down to perhaps property being overinflated by the availability of cheap money, which is rather odd, because the credit crisis back in 2008-9 was born out of too much debt and a property market which was too high. And perversely, here we are 5 years later, hopefully having recovered from that time, looking again at very high levels of debt. So an interest rate rise is naturally going to cause anxiety for us all. And if you're looking at stocks and shares, which is what I do every day, an interest rate rise is also applicable, because companies that have borrowings, which of course they do, just like you and I do, be it a home loan or other borrowings, well, if a company's got borrowings, well, it also is going to struggle with an increasing interest rate, which will impact its profits, and all of a sudden do shares look a little bit expensive. But for the man in the street, Danny, this is important in simple terms, because many people have pensions. And if they're not completely aware of where their pension is invested, most of it will be invested in the stock market. And therefore, unbeknowingly, their value of their fund is currently under a bit of pressure. So that is the most direct, let's say, consequence to the man in the street with what we're currently seeing in financial markets.
Okay, you brought us nicely to the subject of pensions, because I wanted to come on to that. The pensions freedom that George Osborne gave the over 55s in April seems to have been quite popular with that early age bracket for pensioners, 55 to 59-year-olds. They're the most likely to access their pension pots. They've been doing that to some extent, and where's that money going?
Well, pensions is not an area of specific expertise for me in terms of the administration of pensions and what people might be doing with their pension funds. Obviously, I help clients invest money in the market within their pension funds.
So have you seen people between 55 and 59 coming in with a big bag of swag and going, there you go, Phil, do something for us with that?
Yes and no. I think what I have seen, and I think the press talks quite a lot about this, is that because of the flexibility that's now been put into the world of pensions, it's quite easy to take all your money out as well. So whilst it's become easier to be in control of your own pension, and somebody might talk to me about how they might invest that money, similarly, you've got people that are taking money out of pensions because it's become completely or much more flexible in that regard. And I was just reading before I came on the radio that I think a lot of people, I think there was a survey done for a few months over last year or something, are taking all their money out. And what are they doing with that money? Well, I don't know. Are they buying cars? Are they spending it? Are they going on holidays? But I think simplification of pensions sounds good as long as people know and are responsible with the funds, because, of course, at the end of the day, they are there, ideally, ordinarily, to be buying an income for you into your retirement, not to kind of, let's say, spend excessively on a couple of lavish holidays.
Okay. So, just finally and briefly, Phil, should we be worried today then, or do we just carry on, because all these things tend to even out over time?
I think you're right with what you say. Shares have basically gone up for 5 or 6 years. We are probably naturally due a pullback. We have bull runs and bear periods. It could be at the moment that we're going through a bear period, but not necessarily. It's not as if the market's collapsing. Okay. I think in simple terms, the U.S. economy is okay. The Chinese economy is on the radar and is being watched very carefully, but they're still growing well, and my money would be on the Chinese authorities doing everything they can, as we've seen through currency devaluation, to keep that economy going. I don't think shares are excessively expensive, and I think that this would be an environment where one doesn't panic. And if you own shares in a pension fund, well, the chances are you're medium, longer term about the world anyway, not needing to perhaps get your mitts on your pension fund quite yet because you've got a few years to go. I think history has shown you sit tight, you don't panic, and when markets fall, as they have done, somebody like me, I'm always looking for opportunities to invest. All
right, Phil, good to talk to you. Have a great weekend. Thank you. Phil
Cheers,
Scott, SI Capital in Godalming. Thank you very much.